Okay, we got lots of themes that we are watching. Sometimes August is a slow time for the markets, but we are digesting earnings. We're digesting a debt downgrade for the U.S. government. Let's bring in Anastasia Amoroso, Chief Investment Strategist at iCapital, to talk a little bit more about the markets right now. And I wonder if after this huge move in the markets, whether or not investors are starting to wonder if there's any reason to feel uncertain, and that plays into some of the softness we're seeing in the markets today.
Well, good to see you, John. I think that's exactly what investors are wondering, because after this monster rally that we had, especially for tech shares, there is this sense of unease because everybody's looking around and knows that they're not the only one that is, quite long in technology and the stock market, generally speaking. We know that there's been a lot of length accumulated across different types of investors. And if you look at valuations, for example, I was just looking at the semiconductor valuations, for example, they're sort of back up to where they were at the peak of 2021. So with that, when you have the setup, you start to look for a catalyst. And, up until I would say yesterday, there's not a good catalyst to kind of think of because we have this disinflationary trend that is playing out in the United States. We've got this, this Fed that is likely to end its rate hiking cycle this year. That's also in the background. And so there's really not a reason to hit the sell button, especially when the economy is continuing to hold up. But, we do have the Fitch downgrade news, and I think that's sort of been the excuse this morning to hit that sell button and perhaps take some of those profits, out of fear that maybe this escalates to a deeper sell-off.
And, I was citing some stats that Bloomberg put together, something like 47 sessions were for the S&P 500 in a row where we have not seen a decline of more than 1%, which, if we phrase the question another way, what is it at this point that would really derail the market?
Well, I do think that the Fitch story is actually something to watch, and maybe it's the whole notion of the prospect for higher yields that could put a dampener on the market. I mean, look, yes, this is not the same sort of, debt ceiling negotiation, dire state that we could have had in May or that we had in the summer of 2011. But I think Fitch does highlight some of the real concerns that we should have about the state of the U.S. government finances. We're not on a sustainable medium-term debt trajectory. We have budget deficits that are gapping much wider from the 2022 levels, and we have to finance them in the market. And by the way, you look across the world and you look to the Bank of Japan, they're widening their band. The yields are likely to go higher on JGBs, and that could also have a knock-on effect on U.S. Treasuries. So wider deficits, higher international yields, so that could potentially result in higher U.S. Treasury yields that could put the pressure on the U.S. market. So at the moment, I feel confident about the U.S. economy, but this is probably the biggest risk factor that we have is this confluence of budget deficits and what's happening with yields outside of the U.S. that could pressure U.S. yields higher.
And I imagine we're not done with this story of when the interest rate hiking cycle has reached its peak or reached its end point. We had some jobs data in the U.S. today, which highlights a resilient U.S. economy. We have the government report for the U.S. as well as Canada on Friday. When you look at history during rate hiking cycles and what ultimately happens in the markets, are there any standout takeaways?
Yeah, the standout takeaway is once you have the concluding rate hike of the tightening cycle, the market tends to do pretty well in the 3, 6, and 12 months after that last rate hike, assuming there is no recession. And in fact, the numbers are really strong that over the subsequent, 12 months, the S&P could rally. Historically, it rallied up to 20%, in some cases more, if you don't have a recession. And even in a recessionary scenario, after the last rate hike, the markets sort of pull back, maybe by 10 percentage points, and then they've eventually even out and finished the 12 months after the last rate hike flat. I think the reason being is because people kind of anticipate the recession and price it in advance. So the bottom line is the conclusion of the rate hiking cycle by the Fed would be a positive for equities, especially because I think this is the economy that's accelerating. It's not landing rather than hard landing.
All right, great historical context there. When it comes to looking at investing ideas right now, what's top of mind for you? Is there anything you're leaning into?
Yeah, I like the barbell of some of the cyclicals like financials and, of course, with a continued secular growth trend in technology. And, I've certainly not been, very optimistic about the financials, following, the March regional banking crisis. But when I look at some of the large banks today, I think as a result of the soft landing narrative that's gaining traction, you could have the pressure on funding costs that abates. You could have the yield curves, that steepen up a little bit, or at least, get less flat, less inverted. And so that would be a positive for banks. If you have a non-recessionary economy, we don't have to worry about too much about much higher charge-offs, and that's a positive for the banks. And then the last factor is capital markets activity. IPOs, for example, I do suspect that we're going to see more and more of that in the second half of the year, starting in the fall. So that would help some of the investment banks and equity capital markets part of those large banks. So you put all that together, and I think financials can deliver, this positive cyclicality in this part of the cycle. And then you couple that with tech, because, tech, as I've, always said, tech is where the growth is. And, tech is not exceptionally cheap right now, but I think if you adjust for the forward earnings expectations, it's probably not that expensive either.
Okay. Great context. Anastasia, great to have you back with us. Anastasia Amoroso, Chief Investment Strategist at iCapital, joining us. And on the technical analysis side, I know some of you had questions yesterday on Market Call for Keith Richards, who focuses on the charts. And based on the charts, he mentioned as his top picks the iShares TXX Global Gold Index ETF, which is XGD, Nutrien, as well as precious metals play Wheaton. And all of those details can be found on our website and in our Market Call podcast. Robert Gill's going to be on the program today. He's a Senior Vice President with Goodread Investment Counsel. So you can get your questions on Canadian large caps ready for the program. When we come back, Overstock rebrands as Bed Bath & Beyond. We'll hear from the CEO on that transition when we come back.